Everyone, and welcome to the next instalment of the Norton Rose series, Key Trends in Oil and Gas in the LNG industry. I'm Gordon Bunyan. I'd like to welcome you to this session, but I'd like to take just a little bit of time at the beginning to tell you a little bit about what's happening and how the Energy and Resources Law Association is managing the impact of COVID, particularly on our Sydney membership. Firstly, as you know, we hold an annual conference each year, and this year it was to be in Sydney. Sadly, that's not going to be possible. So we have decided to make a change to the plans for the conference. Firstly, it's going to be delayed for a month. We'll now hold it in the middle of November. And rather than it being a two-day event, the plan is to hold a single-day event on the 10th of November. The second thing is it's going to be held as a hybrid. So the biggest complaint we had last year about our learning and lunch program was the inability of members to effectively network and socialise in the course of the conference. So this year we are planning to avoid the COVID restrictions and hold the conference in each of the capital cities where we have branches. So in Singapore, in Perth, Adelaide, Melbourne, Brisbane, and we hope in Sydney as well. So it'll be a face-to-face event in each of those places, and we will present from the program and with a variety of expert panelists and speakers to each of those locations. This provides us a key opportunity to continue the conference, but to present it in a slightly different way. And to provide you with the opportunity both to hear the best that Energy and Resources Law can provide in terms of expertise, but also to allow you to do some networking, if only in your own city. The balance of the two-day program, which has been prepared, will be delivered in 2022 in March in Sydney. We'll have an energy transition conference in Sydney as a state event, and we'd invite you or prepare to invite you for that as well. Full details of this one-day conference in each of your capital cities are going to be available in the next few days, and we'll provide you with all the details of venues, the social event that will conclude the day, together with pricing. And we'd ask you to reserve the 10th for the Energy Resources Law annual sort of COVID light conference in your capital city. And then watch out for details of the Energy Transition Conference, state conference to be held in Sydney next March. Again, let me thank Norton Rose Fulbright for their very generous support of this series. We're very grateful for the involvement of Norton Rose and for all of the other presenters as well, and say that it's a very important part of our national learning and development program. It's all part of your membership, and we're glad you're able to join us in increasing numbers for these events. Let me now hand over to David Jewkes to chair the event. David, thanks very much.
Thank you, Gordon. I'd just like to acknowledge the traditional custodians of the lands on which we all meet today. And I would like to pay respect to the elders of these lands, both past, present and emerging, and extend that respect to other Aboriginal and Torres Strait Islander peoples here today. So thanks, Gordon, and thanks to all of you for attending today's session, which I hope will be a really engaging one on the key trends in the oil and gas / LNG industry. It's my privilege to chair this session with a group of distinguished panelists. As Gordon said, my name is David Jewkes. I'm an M&A and Securities Partner within the Norton Rose Fulbright Perth office, I work a lot with clients in the energy sector, predominantly on strategic M&A and equity capital raising initiatives. I'm joined today by Stuart Nicholls, who's the Managing Director of Strike Energy, an ASX-listed WA company building an integrated low-carbon energy and fertiliser business. Strike aspires to be Australia's lowest cost onshore energy producer and a globally competitive urea manufacturer with net zero carbon emissions by 2030. Hugh Sheppard, who is the Vice President with SCF Partners, a global resources services investor with a 30-year history of investing in energy services and equipment businesses. In his role at SCF, Hugh sources and supports investments in energy service companies in Europe, the Middle East, and Asia Pacific. Joe Feldman, who was an arbitration and litigation special counsel with me in the Norton Fulbright Perth office. Joe has over 15 years experience working with government and private sector. She has broad experience in disputes under national laws and international law and has acted for and against states in investment treaty arbitrations. And finally, Ben Smith, an energy partner based in our Singapore office. And Ben advises on oil and gas matters and transactions with a particular focus on the development of LNG projects and the long-term sale and purchase of LNG, but also advises on all types of upstream developments, mergers and acquisitions, and joint ventures. So if we could give a virtual clap for the panelists to welcome them today. Thanks all. Just a quick bit of housekeeping as well. If you've got any questions during this session, I think it's easiest for us to manage if you actually type them into the Zoom chat function. And we'll endeavour to get to those as we go through the session to the extent they fit within the topics we're covering. Alternatively, we're hoping to leave a little bit of time at the end to answer any questions. And if you put some in and they remain unanswered on this session, we'll endeavour to come back to you directly with responses following the session. So it's a really timely session and topic today. If you've been following any of the news, half the articles that grace the Business Review section of the Australian on the weekend related in part to today's session. The key headline, foreign funding for fossil fuels, was calling for the Australian government to relax some of the foreign funding restrictions to allow greater funds flow into fossil fuel investments in Australia in light of the local banks somewhat turning off the taps to those investments. There was scuttlebutt about BHP Petroleum's potential sale to Woodside. And of course, we now know that that's more than mere rumour. There was also an interview with the CEO of the Australian Council of Superannuation Investors, Louise Davidson, where she was talking about how carbon initiatives are driving superannuation investment. And so I think, Ben, there's sort of no secret that, you know, this is a hot topic in Australia at the moment. You're based in Singapore with an ear to Asia. What do you say are sort of the key developments in the industry in Asia in the last 12 months?
Yeah, thanks, David. I must admit, I've been looking south with envy at the headlines coming out of Australia at the moment, frankly. You know, we haven't really seen the big M&A mergers. I mean, obviously, you know, the size of the companies, particularly here in Southeast Asia, are smaller anyway. But you know, we certainly aren't seeing a Santos Oil Search, Woodside, BHP type deals in this part of the world, and we haven't seen, you know, the other big trend, I would say, coming out of Australia is these big asset sales, like, you know, the one that Shell has done involving its interest in QC LNG. What we have seen over the last 12 months-ish is, you know, a number of the majors exiting from upstream assets that they've got in Southeast Asia. And examples of that include Shell selling out of its Malampaya gas project, which was, you know, has for the last 20 odd years been pretty much the only gas project in the Philippines. They sold out of that earlier this year. Repsol had a portfolio of assets in Vietnam and Malaysia and sort of across the border there. They've sold out of those assets. and Chevron has exited the Rokan field in Indonesia in recent months as well. So, you know, it's all heading the same way. I would say the next sort of trend that we're seeing is the impact of energy transition. And, you know, less so in the M&A space, but certainly in terms of what's going on in the LNG market, we're seeing an increasing focus on carbon and greenhouse gas emissions in LNG sales. So there's been quite a lot of stories coming out of green LNG sales. Primarily, I would characterize that as being Asian utilities sort of buying one or two so-called green LNG cargoes where the emissions have been offset. And additionally, we've seen Pavilion Energy down here in Singapore, who have entered into they've announced 3 10-year contracts where they're looking to track the emissions associated with LNG delivered to them. So, you know, it's clear that people are beginning to think about energy transition issues, and also in the LNG space, we're also seeing a wave of Qatari LNG coming out of, you know, their big expansion of the North Field, and a number of Asian buyers, particularly in China, have been entering into long-term contracts in relation to that. The third trend I would say is I'm not sure it's resource nationalism, but it's resource localism. So if we look at the buyers on those 3 M&A deals that I mentioned earlier, Shell has sold its assets in the Philippines to Udena, which is a large or rapidly growing Philippine oil company that has developed very quickly, particularly under the current administration in the Philippines. Repsol has sold its interests to a KL based company called Hibiscus, and Chevron's interest in the Rokan field has been taken over by Pertamina. And I would say that you know, as the big international players are you know, moving out of the upstream here, their interests have been taken over by local players. And that makes it a little bit more of a challenge, perhaps, for other international players who want to, you know, get into this region. I mean, on 2 of those deals, we were representing UK-based bidders, and it's you know, it's quite difficult to know exactly how to pitch your offer when potentially you've got, you know, local players who may be able to improve their proposals using local factors, which perhaps is more difficult for the international players to match. So yeah, it's an interesting time. I mean, I was reading one of the bits. I think Macquarie had recycled a quote from Chevron's CFO from earlier in the year when Chevron was looking to acquire Noble. And I think his comment was, there's still too many CEOs per barrel of oil equivalent production. You know, I can see we're entering a period of consolidation in Australia probably, but out here, it seems like we're going the other way. Yeah. So, yeah.
Yeah, really interesting, Ben. I mean, I think on the theme of difficulty for foreign companies perhaps to have the same inside run on transactions in different jurisdictions throughout Asia. Be interesting, Joe, for your thoughts on how the sort of government interplay relates to that. And I guess, you know, some of the differences that people might need to think about when you're doing a transaction and dealing with the government in Australia versus, you know, what's happening throughout the Asian markets.
Yeah, absolutely. I think what we've seen across the region from governments has certainly varied over the last year. But what you are seeing that's consistent is quite a lot of government investment in the space and engagement in the space, especially as they drive their COVID recoveries, and an increased interest in regulating the space. So if you look at Australia, of course, you see the Australian government simultaneously focusing on a gas-led economic recovery. That's spent about $9 million in advice and modelling alone on that advice and regulatory advice over the last year, while at the same time the Australian government's focusing on passage of this legislation to put a greater focus and scrutiny of decommissioning and decommissioning transactions. And then when you look across the region, you see other countries like East Timor, who are so dependent on LNG for their sovereign wealth, passing legislation and regulations to try and attract investment in LNG, while at the same time you're seeing that the big consumers in Asia, Japan, South Korea, China, announcing carbon neutrality aspirations, announcing their intention of border carbon adjustments, and putting huge amounts of government spending into green stimulus following COVID. So China committing 200 billion last year to green stimulus, South Korea 60 billion. And the projection that there'll be 250 billion in renewable investment in 2025. So Singapore, of course, investing in solar quite significantly. So, but simultaneously, they also will be facing the question of how they regulate for decommissioning. So many, of course, Asian governments have in place quite flexible regulations on decommissioning, certainly much more flexible than those in what we've seen in the North Sea or what Australia is putting in place now. But as has just been pointed out, with a lot of ownership transferring back to national entities, and that real risk of decommissioning costs being borne by governments and taxpayers, there's probably with those more flexible decommissioning regimes, there's probably a higher risk of retroactive obligations or levies being imposed if that decommissioning and sort of resource nationalism starts to bite. And certainly there are ways that investors should be looking to address that. Primarily, of course, in looking to make sure that they structure their investments in the region through to ensure the protection of investment agreements, investment treaties. Because we have to remember that the whole region is really covered in these investment agreements that have been entered between governments to ensure protection of the investments of foreign investors. So, the counterbalance to Ben's point that there's this benefit to the local players, and the local players are picking up a lot of assets. I think the foreign players should be scrutinising very closely government behaviour, both in terms of any favouritism shown to the local players, any advantage shown to them, to the sort of conditions or regulations being imposed on the foreign players, to where government money is being spent and whether that's being spent fairly or evenly across players, and whether, when there's a risk of government regulation coming in that would either diminish the value of an asset or disadvantage a foreign player. All of those sort of actions that governments might be expected to take in the coming years in this space, which we expect to see more regulation and spending in, and especially players that have local entities that they might be inclined to advantage. Foreign players should be watching that action very closely, because they will have rights under investment treaties to take governments to arbitration if they don't honour the commitments these governments have entered into that were designed to attract and protect foreign investment in the space. And the benefit, of course, for Australian investors is they have significant protections under investment treaties throughout Asia, and the recourse to investor-state dispute arbitration should governments not meet their legitimate expectations of the investors, not protect investments, not behave fairly and equitably, but simultaneously for investors coming into Australia. Certainly ones coming through Singapore have particularly good protections for their investments, should they be concerned about Australian government regulation in this space going forward.
Yeah. I think the point that both you and Ben made, Joe, about sort of the energy transition is super relevant to this. And I mean, I think we'd all agree the major trend that's going on in the industry and has been for some time. And you'd say, coupled with the social license to operate, having some sort of pronouncement or commitment in terms of decarbonisation is almost a part of the ticket to play these days. And I think, Stuart, what Strike's doing is fantastic to that end. It'd be great, I think, for the audience just to hear a bit about your net zero 2030 strategy, and also just how sustainability is impacting Strike as a business and what you're doing.
Yeah, thanks, David, and thanks to Norton Rose for having us along today. So, I mean, you look at the industry, and we've got 50% of Woodside's market cap that's gone walkabouts, you know, a good 60-70% of Beach's market cap that's missing. And fundamentally, oil and gas prices are at levels which, you know, are in regional sort of multi-year highs. That's a strange place to be. So equity markets are starting to diverge away from fundamental analysis, and they, I guess, feedback that we get at Strike is that they want to see an investment that can be successful in 2030, 2040, and a 2050 environment. You know, 2050 seems a long time away, but for an energy company, you know, that typically you'll see the outcome of your resources there. So at Strike, being a contemporary business and having a new series of resources to be able to develop, we sort of approach that with a very new age view. So we came out with a very integrated strategy. I've usually put up a Strike complexigram at this point in time that fundamentally talks about how our natural gas assets that we have in the Perth Basin, which is adjacent to the existing infrastructure, just 3 hours north of the Perth capital city here in Western Australia, allow us, through their low cost, low impurity, and you know, closeness to market, to generate a very low carbon intensive natural gas source. And because of that low carbon intensity and low cost nature, we're also able to integrate that gas into downstream processes which have typically been run out of Australia due to high energy costs. And urea manufacturing is exactly one of those things. If you think about Australia, where grain is its 5th largest export, it's a bit peculiar that we import 100% of the urea fertilizer that fields the yields of those grains. And so with our low carbon and low cost natural gas, we're actually able to start to bring urea manufacturing back to Australia here. Now, urea is a great thing for carbon sinking. So yeah, I think if you cast your mind back to your sort of year 9, year 10 chemistry or so, you take your methane, you stick it through some minor processing to synthesize hydrogen. That then spits out some carbon dioxide, which you should keep to one side. You mix the hydrogen with air to create ammonia, and you stuff the carbon back into it, and it granulates into urea. That urea then ends up back in the ground, and you sort of complete a part of the carbon life cycle. But it also gives Strike a foot into the hydrogen economy, which is fast approaching us. Now, that's going to be a long economic road to profitability, but it is something that investors want to see today. And so when you add all of that together and sort of some accidental geothermal assets in which we found ourselves co-located with our natural gas, it starts to come together in a concert as actually being able to be carbon net zero by 2030. When you look at some of the industry leaders or Australian leaders in terms of decarbonisation, Fortescue is often held up there as the benchmark or the yardstick and the pace setter for decarbonisation with their own 2030 target. As an energy company, we feel that we can offer an incredibly competitive and differentiated value proposition to our potential investors and current shareholders by being 2030 net zero. And that's by being not necessarily focused on absolute price, but overall recoverability of our natural gas through the deployment of that gas into areas like the domestic market here, as well as into urea fertilizer. So it's a little bit about our strategy and how we're thinking about it. And that aggressive and ambitious target of 2030 net zero is attracting sustainability investors to our register, which is, I think, a tip of the cap to the way that we've rolled out our strategy.
Yeah, I think it's great, Stuart. And I mean, on the point of investors being keen to see a strategy and the money following those companies that have clearly enunciated one or some way along that journey. Hugh, I know SCF's sitting on dry powder north of $500 million that you're looking to deploy, and it might be interesting for the audience just to understand as an investor in the space, albeit in services businesses that work with the oil and gas and LNG companies. What sort of edicts are you getting from your private equity investors in relation to where you're putting the funds?
Yeah, thanks, David, and thanks for having us. I would say we're not necessarily getting any edicts at this stage, but we are certainly getting fairly strong feedback from our investors. For one reason or another, you need to move or you're going to get left behind, and it's going to become much harder to raise funds in the future. I mean, we're structured such that we are lucky we have accommodating investors that as long as we stick to the mandate in our agreement, they're not giving us edicts as such. I would say we have a large number of university endowments, American university endowments as investors. They've got some very vocal stakeholders obviously on campus telling them that you need to divest all of your oil and gas investments, or all of your sort of oil field service investments, these types of things. So they're pushing us for a certain reason. And then we've got other investors who are more focused on returns, and their question is, what's the terminal value of an oil field services business in 5 years when we're 5 years further along the energy transition sort of thing. And so I think for various reasons, all of the investors are saying, you need to tell us how you're thinking about this, what you're changing, and what the investment pattern looks like in the future. I think the other really important impact we've seen, and it goes to that point about terminal value, is generalist financial sponsors have effectively abandoned the oil field services sector. And corporates, because they've been focused for, call it the past 5 years, they've been so focused on repairing their balance sheets and demonstrating to their investors that they're cash generative, and they've largely put M&A to one side as well. So while we think there are some good investments to be made, exiting at the moment from our existing portfolio is a challenge because so many investors have deserted the space. I think how that then influences our investment strategy, we feel like we're in a good position as dedicated service and equipment investors. So we see lots of opportunities for our portfolio to transition gradually with their customers using the core capabilities. So the pipes and valves that our companies supply to oil and gas operators are already starting to go into carbon capture projects, into hydrogen projects and these types of things. And so we have an opportunity to transition with our customers. I think another important point on that front is that some of the biggest investors in the energy transition are oil and gas operators, the BP being the pin-up boy in that regard, and Equinor as well. So our companies with a long history of working with these types of businesses have an opportunity to transition alongside them. But then beyond the existing portfolio, I think there is very much a shift in how we're thinking about new investments. So obviously new energy sources, renewables, hydrogen, these types of areas is a key theme. And we recently hired a new operating partner, a guy called Steve Lockhart, who was CEO of TPI Composites, who are the largest wind blade manufacturer in the world. And that's been a great new perspective to have in the firm, help us think through these issues. I think that as well, LNG will be an important fuel for decades to come, and we see a long future in providing services and equipment to maintain LNG production. Obviously, there's a big base of that in Australia now. And then probably the third one I would touch on is we're looking very closely at where we can invest to help decarbonise oil and gas production. So a good example being methane detection and leak remediation. So stopping fugitive emissions that can help massively reduce the carbon footprint of the production. So those are the types of ways we're thinking about it. And I think we've already shifted, our companies have already shifted and changed their perspectives. And I think new investments over the next 2 or 3 years will reflect that change in perspective.
Yeah. Dave, I'll just sort of put one thing that Hugh's talking about, which I find really interesting is the future and success of oil field services. And it's something that at Strike we've looked into the window of, are we going to be short of mudloggers and guys that can operate drilling rigs in 5, 10, 15 years time, or are those skills that are just not going to be invested in by universities? I mean, I think we've already seen the School of Petroleum at Adelaide University almost shut down and have to merge with IT of all things. And geothermal is actually one of those great investments where everything that you need to drill a oil and gas well is what you need to drill a successful geothermal well. It's the same geology, it's the same the same drilling rigs, it's the same guys running the cement units and doing the petrophysical evaluation of the rock properties at the end of the day. And so I can really see there's a large part of our industry which can invest their skills, their time and their careers into zero carbon energy. And for those that don't know much about geothermal, I mean, it's the panacea of renewable energy because it's 24/7, 365. And it doesn't matter if the sun's shining or the wind's not blowing, it has a small footprint on the ground and can generate dispatchable synchronous zero carbon electricity. So, I'm a big fan of what Hugh and those guys are doing, because I think if you look far enough out, oil and gas services have a long way to evolve into this energy transition.
Yeah, no, it's a good point, Stuart, and thanks, Hugh, because I think you're right. A lot of the transgental businesses that support oil and gas companies in what they do need to start thinking about, we've got these great skill sets that we've developed over many, many years of being best in class globally at some of what we do. How can we repurpose that at the margins, but to move in quite a different direction into the future? And look, I know it's a passion project of Ben's, but Ben, it's sort of relevant to what we're talking around, is this idea of gas as a transition fuel. I mean, is that something that you're seeing through Singapore, through the Asian markets, is developing in terms of its relevance?
Yeah, we didn't really focus on these transitions when we had our call, but actually they're working very well together. And there's a lot of what's just been discussed, which is kind of relevant to this as well. I guess perhaps one of the first points to make is in terms of that example of people transitioning their skills. Whilst I haven't been involved with the North Sea for a very long time, what one sees there, where all of these offshore service companies are now very busy putting up windmills and so on in the North Sea, is a really good example of how to do it. Is that actually, as Hugh was saying, these oils, what was an oil field services company can make that transition. I am sitting here in Singapore as a lawyer with a nice tie on. It's very easy, but I mean, it's not that much of a transition. In terms of gas as a transition fuel, and particularly in this part of the world, in terms of the trends, frankly, I don't think it's particularly clear at the moment. I mean, the story that I think everyone would like me to tell you is that, and particularly those of us who have focused our careers on the gas industry, is, well, look, gas has got a big role to play in this part of the world. Despite what Joe was saying about renewables investments in this part of the world, the fact is that, particularly when you look at Southeast Asia, there is not an awful lot of wind here, and there's not an awful lot of space for big solar projects. Yes, Singapore is rolling out solar as fast as it can, but they're putting those on the top of apartment blocks. And we've just commissioned our largest solar array, which is floating on top of one of the reservoirs here. So they really are squeezing them in around the cracks. I think long term it must be right that gas has got a very important role to play in the energy transition, and I think that is the reason why you are seeing more of these green LNG deals in this part of the world than anywhere else. Is that people are recognizing that we're stuck with gas for quite a long time. Therefore, how can we reduce its greenhouse impact as much as possible? the reason why I say that the view is not particularly clear is that, you know, there are some sort of contrasting approaches being taken to this. So, I mean, if you take Japan, which, you know, obviously has traditionally been the largest market for LNG in the world, they have recently published their latest energy plan, and that had, frankly, a lot of us in the gas industry pretty startled. Their prediction was for 2030 that 60% of the energy demand in Japan was going to be supplied by renewables and nuclear. And anyone who's been to Japan knows that, you know, whilst it's not quite as acute as the issue here, there's not a huge amount of space again for renewables, and you know, they've picked a lot of the low-hanging fruit in terms of renewables and reducing energy there. The big unknown in Japan is exactly how successful they're going to be about bringing back their fleet of nuclear plants, which was you know, all mothballed after the Fukushima disaster. But you know, I mean, I'm not a sort of expert in predicting these, but a company like Facts Global Energy has predicted that, you know, that mix of renewables and nuclear will be about 40%. So that's a 20% gap, and that 20% is likely to be occupied by LNG. So, you know, whilst the government has great aspirations for dramatically reducing, you know, all of the fossil fuels, including gas, I think it's likely that LNG will continue to occupy a very important part of the energy mix in Japan for certainly for the foreseeable future. The other sort of gorilla in the room, if that's the right phrase, in this part of the world, of course, is China. And China has been running around buying up huge quantities of gas over the last, you know, certainly 5-10 years. You know, we've seen the commissioning of 2 east-west pipelines from Central Asia. They have been building LNG receiving plants along the coast and entering into a lot of long-term contracts. I mean, a lot of this expansion of the North Field is going to be underpinned by Chinese demand going forward, I would expect. And yet, at the same time, you know, they have they've got 96.7 gigawatts of coal-fired power generation under construction at the moment. And so, you know, and actually coal demand in the last year has gone up in China. And so it's a bit of a mixed message. I mean, you know, I'm hoping that, you know, what is confusing people at the moment are just bumps along the road, and that we are moving to, you know, quite a good period for gas demand. But, you know, as I say, it's not clear. I mean, maybe the Chinese are thinking, well, look, you know, we're going to keep burning coal for the moment, and then by that stage, the renewables technology will be in place to make a switch, and we won't need that gas as a transition fuel other than the gas that we're already burning. I mean, so that's on that part of it. I mean, the other part of it, just looking at the gas industry itself, and this is picking up on points that Stuart and Hugh were raising earlier, is that there is, you know, with some very obvious exceptions, there is not a huge amount of investment going into the development of new gas fields at the moment, anywhere in the world. And yet, you know, for Asia, as I've already said, you know, gas is going to be a very important part of the fuel mix for quite a long time. And the danger here is that we see that, you know, as the investment in gas is reduced, and gas prices have already decoupled from oil prices, and you know, they're already beginning to climb. But if the investors, not pointing at anyone here, are not willing to invest in gas projects, then the price of gas is going to go up and up and up, which means that those who do make the investments are going to make an absolute killing. And those of us on the demand side here you know, we could see gas pricing itself out of the market, which would be, you know, I mean, that's the way capitalism works, but it would be a surprising result. I see everyone's taking their mutes off, so.
Yeah, but I mean, I totally agree with that. I can see gas investment coming from private enterprise and public companies sort of going away of the past, just due to the transparency, the greater level of, you know, net zero requirements that the public company investors are asking of energy companies. You know, we're going to see the Glencores of gas, you know, Trafigura's, etc., really start to dominate the next 10 to 15 years, where they have a source of capital that is not necessarily as influenced by the sentiment of the energy transition. And I totally agree with that. I mean, we've got sustaining Henry Hub gas prices above $4 at the moment. You know, we've got LNG prices above $16 an MMBTU. This is during summertime, where you know, we would typically see depressed pricing environments. So, you know, there is a big divergence between reality of you know, profit and loss statements and, you know, what equity values are on public listed enterprises.
And maybe this is where the Udenas and Hibiscus and the other, you know, smaller privately held companies that I was mentioning earlier, you know, actually have quite an opportunity where you know, the BPs and Shells and Repsols of this world don't want to touch it anymore, and those guys come in and are able to develop them without you know, publicly traded shareholders sort of breathing down their neck.
I would just agree with what both of you guys said from the high level the gas as a fuel perspective. I mean, we see it as a theme to be investing in for the next 10 years. I mean, from a services perspective, it's global, it's complex, so there are lots of higher margin niches to go after. And the skills are transferable to hydrogen, carbon capture, cryogenic gases, going back to that earlier point. I think a good example of someone who's done well out of this theme is Chart in the US, and they build a lot of the equipment that goes into LNG facilities. Their stock price is doing fabulously well. They're trading on a sort of energy transition multiple, if you like, because they've been able to tell the story that gas is good and look, we can do all this other stuff within the energy transition. So, no, I think LNG has a long future ahead of it.
I think, Ben, your point about sort of some of the geography and Singaporean issues in terms of space leading to the need to put, you know, solar panels on the top of skyscrapers, and it's obviously not a problem that we have here in Western Australia. I think there's pockets of our state where it's the perfect blend of wind and sun. And you see projects like the Asian Renewable Energy Hub getting a lot of interest and traction off the back of that. So I think the geography is such a big feature of this discussion, and you know, WA has something quite special in that respect. Look, I'm just conscious of time, so I think maybe we'll slightly transition to a different subject matter.
Sure, you did that.
Just to remind the audience, please do write in any questions if you like for the whole panel. If there's particular people you'd like to hear from on something, go ahead and do so. So look, I think something else that we've seen a lot of in Australia, and goes to some of my opening remarks, is just the consolidation that's happening across the industry. And there's a lot of, I think, opportunities out there. There's BHP and Woodside in play, Santos and Oil Search, Stuart, Strike announced yesterday divestment of an asset. And, you know, we've seen clients, Shell, Total, doing sort of a very active in terms of divestments and acquisitions in terms of rationalising their portfolio. I mean, Stuart, perhaps we'll start with you. You know, the Cooper Basin sale, the permit sale, and then also, you know, what you see in terms of Strike's place in potential growth, inorganic growth, and if you think there'll be consolidation in your area?
Thanks, David. Yeah, look, the space in Australia is moving very quickly. We're seeing some transactions that should have happened decades ago happening now, because I think we're getting to a point where if you don't find your buyer, you may never have one, and people will be faced with large, long-tailed capex abandonment liabilities and ongoing investment in order to be able to keep things operational. So I'd say, again, we're hearing in oil and gas, scale is better, and that's a thematic that's been going on for decades, and I think it's been fairly a self-fulfilling prophecy, because it's been led mainly in part by the international oil companies and super majors. But I guess what we see at Strike is a completely reverse of that. We want to be able to offer a very targeted investment proposal to our potential shareholders, where we've got the best part of 7,500 square kilometres of gas acreage, 3,500 square kilometres of geothermal acreage, and 60 hectares of land where we're building our fertiliser plant, all within 150 kilometres of land along the Midwest coast in the Perth Basin. And we can have a much more concentrated series of skills, geologists, geophysicists, drilling engineers, who understand those environments a lot better than having that diversified, multi-jurisdictional, multi-country, multi-continental approach, which has often been celebrated as the way to minimise risk. I think understanding the government or the energy regulation in which you operate is going to become more and more critical as clean energy regulation starts to become a very dominant force in the way investment proposals or decommissioning activities are actually rolled out. If you look at Australia, for instance, the clean energy regulator is making energy products, or iron ore, for instance, carry its scope 3 emissions as it starts to export those. That's a very different perspective than what you have in America, where as soon as it gets on a boat, it's carbon neutral again. So it's this sort of interesting legislative environments where people will start attracting carbon pricing to their products, and unless that they have a good handle on where that carbon is accounted, then who is ultimately going to be paying for it? Is it the shareholders, or is it going to be a customer? And I think that that's sort of the way I see the world going, and why we're going with a much more focused strategy, exiting basins like the Cooper Basin, where you mentioned, for us, rather than looking to have a diversified footprint, East Coast, West Coast of Australia. So yeah, I see consolidation continuing to happen, and that's mainly because I think you're going to see the wheat and the chaff separated in terms of public company operatives, people who can continue to convince investors that they have a story which is going to transcend decades of carbon legislation and energy transition. And that's a long-term investment for the future. Otherwise, people will start to wither on the vine.
Yeah, look, I think that's right, Stuart. And to that end, there's probably also players that are starting to look offshore, perhaps into emerging markets, to try and find opportunities and value. I mean, Joe, that's an area that you've had a lot of experience in. A couple of comments, if you could, for the audience, just on some of the tips and traps, perhaps, for if you're looking, or have clients looking in emerging markets, what to look out for, and how to best protect your your client's investment.
Yeah, absolutely. Thanks, David. I mean, I think, as Stuart says, like, investors in this space are looking at 30-year propositions, and the next 30 years in this space is going to see, significant regulatory engagement from governments, and, as Stuart said, quite different regulatory approaches across jurisdictions. So I think investors need to be very closely tracking what governments are doing and looking at doing, and making sure they're in the best possible position to both influence that regulatory policy, to hold their own in negotiations, and where necessary to be positioned to take a dispute against governments. And so, one of the best ways to do that is to use the effectively free protections that are in existing trade agreements and investment agreements. So looking at how you've structured your investment so that you're automatically covered by those protections that have been negotiated for you by governments. And so you don't have to pay any negotiating capital to have. And so it's worth looking at how your investment is structured so that you can get some of those protections. You know, the obvious way is if you're a US company, you don't have a lot of those protections in Asia because the US has lagged a little on their investment agreement negotiations with APAC governments. So you'd be looking to either channel your investment through an Australian subsidiary, because Australian companies have a lot of protections in Asia, or if you're coming to Australia, channeling through a Singaporean subsidiary, they have a lot of protections in Australia. But those protections will mean that when you're negotiating conditions with the government over your asset, and we can expect to see, you know, an increased focus from governments on the environmental conditions or on the carbon capture obligation, increased focus on decommissioning. When you're negotiating with governments over those conditions, far better to be doing so within your back pocket, the already provided protections for a foreign investor, you know, to meet your legitimate expectations, to give you fair and equitable treatment, to not diminish the value of your asset, including through regulation. So better to have those rights in your back pocket when you're negotiating with the government over the conditions they're attaching. Better to have those rights in your back pocket when you're lobbying a government for the sort of regulatory approach it's going to put in place. And to have those rights in your pocket if you do need to take them to a dispute. And we've seen that with, you know, Thailand was taken to a dispute because it tried to retroactively apply decommissioning obligations. You've seen that throughout Asia, disputes brought over the conditions being applied or leases not being renewed because of environmental conditions, disputes over whether companies have met carbon capture standards or environmental standards that were imposed. And I think also to position themselves to try and navigate what is not a uniform approach between governments, as Stuart has said. And some of these border carbon measures, some of these carbon calculation measures are going to be very different. And meeting one will not mean you're meeting some of the others. And so again, being in the best position to be a driver of government policy is going to be key. And the best way to do that is to already have protections under a bilateral investment treaty or a free trade agreement. And the benefit for this region is there are a significant number of them that offer very good protection for investors already and offer them investor-state dispute settlement as a resort to go to arbitration without any need to negotiate those protections themselves or to pay any negotiating capital for them. So being aware of what those protections and rights are and making sure you're picking them up for free will just put you in the best possible position to both shape the government regulation coming and to protect the expectations and interests you started off with at the beginning of a 30-year investment that are at risk of sort of being eaten away at or changed as government policy sort of rapidly evolves in this space. Both because there's not a lot of it there yet and there will need to be, and because there's sort of, it's quite a politicized issue through the public interest, as we've seen. It's quite likely to be one where governments change from election to election. And there's still that risk of court rulings like Shell saw in a Dutch court that has now led Shell to divest itself of so many assets. So, you know, there's a lot of factors pushing on this space that are going to make it a rapidly changing investment environment, which is not what you want to be facing when you've got a 30-year investment. And so using those investment treaties to stabilize that regulatory ground as much as possible will be key.
Yeah. It's always a bit of a tension, isn't it? Because you're looking at something, if it actually goes ahead and it's 30 to 50 years worth of investment, well, it's worth spending the money and time to get it right up front to safeguard what you're then going to do. But you also have, you know, you want the downside risk protection of not committing too much capital to trying to get it off the ground initially. So we do see that tension with clients a bit.
Absolutely.
Look, I think just conscious of time, we've had a couple of questions come through that I might quickly throw out to some of the panelists. The first one, Ben's probably most appropriate for you, given it relates to Singapore. So that is, are the Singaporeans keen on buying electricity via undersea power line from Australia?
I thought for a nasty minute you were going to ask me to answer the Canning Super Basin question. Okay, so as far as Singapore is concerned, it's interesting actually. So EMA, which is the regulator here, has recently put out a tender for green. Basically, they want to buy renewable energy from outside Singapore, which in reality means from Malaysia at the moment, just given the infrastructures in place. But it's very much seen, and you know, there are a lot of issues associated with this tender, which I think is going to make it quite difficult for people to comply with. But it's very much indicative of the way that EMA and Singapore Inc. is thinking about this, and who's going to buy this green power? Well, the other sort of regulatory lever that's been pulled recently is that they have said that there will be no more data centers in Singapore unless those data centers can show that their source of energy is carbon neutral. Now, as you can imagine, Singapore is a highly data-centric environment, and everybody here wants to build data centers. So, you know, this way of bringing in green power from somewhere else is seen as a potential solution to some of the issues that I was talking about Singapore earlier. In terms of the undersea power cable, I'm not quite sure where that particular project is now. I mean, it certainly is an option that has been talked about in the past. I must admit, my little mind boggles a bit at the thought that there's a power cable, you know, winding its way across all of those islands of Indonesia and so on, and making its way to Singapore. But you know, certainly in terms of, you mentioned the Asian Renewable Energy Hub earlier. I would have thought that Singapore is certainly looking at hydrogen, and it would certainly be a potential market for that project and other similar projects. So trying to buy renewable energy to bring Singapore from overseas is definitely on the agenda here.
Right. Thanks, Ben. Look, on the assumption we're not going to get cut off in 2 minutes, Stuart, probably a question that you're best placed, not just of anyone on this call, but probably anyone in the market to answer, which is, what's the future of the Canning Super Basin in WA?
Yeah, look, sort of just trying to think about that. So the Canning Basin, for those that don't know, is up in the Kimberley in Western Australia here. The Kimberley is a fairly remote part of the country, and it's quite environmentally sensitive. It's quite undisturbed in terms of mining and other resource projects. And so you start with those two things and you go, well, that's already, you know, going to be a pretty difficult thing to do. Remote basins of Australia are seeing investments such like the Beetaloo Basin in the centre of Australia, and that's because it can be and will be connected into the East Coast gas system, where we're seeing gas prices in that $10, $12 a gigajoule long term and sustainable. And so I really think that you need a commodity price in order to be able to develop things like the Canning Basin of that East Coast ilk in order to be able to bring that gas to market. Typically, the natural gas of the Canning Basin is tight, and it's been an unconventional area where a hydraulic stimulation or fracking has had to be deployed. And, you know, that's again something that people want to do in a remote basin where mobilising frack spreads into environmentally fairly sensitive areas. I mean, we saw the James Price Point opposition for the Browse development some 10, 15 years ago in here in Western Australia as being, you know, fever pitch. So I don't see it as an easy place to do business. There is some oil developments where Buru Energy and Origin Energy are investing alongside Buru going along. That looks, you know, reasonably interesting, but I still struggle to see how the economics of that oil stack up when you're trucking it several thousand kilometres to, you know, up to Wyndham, or 700 kilometres, should I say. I think they would need to find a much more localised consumption point or evacuation point for that oil in order to be able to see a proliferation of investment in the Canning Basin. So, you know, it's getting harder and harder, and so going to places where business is hard doesn't feel like downhill skiing to me. Thanks,
Stuart. Look, I think that probably brings us to a natural close. So once again, if you could just virtually give your appreciation to the panelists, Stuart, Nicholls, Hugh, Sheppard, Ben Smith and Joe Feldman, on what's been quite a wide-ranging and interesting session today. I think obviously energy transition is front of mind for the industry. Talked a bit about gas as a transition fuel and what investors are looking for and how they're driving decision making. And then also that we're seeing, you know, portfolio rationalisation and potential new opportunities. Thanks to Ampler as well for allowing us to host these sessions. And I think that's all from me. Thanks for attending.
Thanks everyone. Thanks Norton, Rose, Fulbright.
Thanks everyone.
Thanks, David.
Bye.
Thanks, everyone.